What we're going to talk about today is we're going to talk about what we see in the UK. We're going to talk about what to do with what we see in the UK, and we're going to talk a bit about how we do it. So with this, I'll move on to my first slide, which shows the topic of our name and our view of what we think. And that is, we believe this is a once in a generation opportunity. And by that, we mean for new investments. So for the bulk of this presentation, I'm going to be talking about new investments being made at this point in time and in the coming years, rather than existing portfolios. In the Q&A, I'm of course happy to talk about existing portfolios as well, but really the focus now is on new investments at this point in time and beyond. Our view is very much that this is a once in a generation opportunity. Russ provided a number of slides with both positive reasons and fearful reasons for the future. The way we would like to look at things, though, is a bit broader than just looking at the equity markets. We want to look at both public equity and private equity. And the reason for that is because private equity is becoming an increasing important part of the UK investment landscape. But before we get into there, let's talk about what we see in the UK. Russ said the words that there's an awful lot of money providing support, and I must admit I couldn't agree more. I think that's one of the best sentences for what's happening today. This slide shows some of those things, some of those topics of support. On the left-hand side, we have various different government schemes. We have been updating this slide on a weekly or monthly basis for the last 3, 4, 5, 6 months, and almost every time we update it, there is a new change. There's new changes to furlough, new changes to employee costs, successes of furlough, there's topics about deferred taxes, there's topics about deferred loans, and there's the various different support schemes by the government. Here we list the coronavirus business interruption loan scheme, the CBILS. There's also CL bills. There's also the bounce back loan scheme. There's also the future fund. There are many different schemes that are available to companies as a way of accessing capital. Now, the interesting thing from our perspective is almost all of that is debt capital. Almost all of that is debt. And likewise, on the right-hand side, when we look at the number of vehicles that are currently being raised or available to companies, most of those are debt. And this page doesn't even include the topic of bank debt. So when we speak to management teams, and particularly really successful management teams, the thing that we keep on hearing is that debt is readily available, but there is not much equity. This seems kind of counterintuitive to where we are, and it's certainly also counterintuitive to what a lot of people are saying is needed. Whether it's business leaders, whether it's bankers, whether it's government, a lot of people are talking about the need to put new equity into the system. And that's something that we thoroughly agree with. There has, though, of course, been a bit of equity that has already got into the system. So let's show this from a public equity perspective. This is quite a complex slide, and I won't go into every single part of it, but I'll summarize the chart on the left. On the left, it shows the value and number of raises of equity in the UK. And what you see when you get to 2020 and you see H1 and H2, you do see a spike. But what I would like to highlight is the little bit in orange at the bottom. The little bit in orange at the bottom is the value of equity raises for companies valued between 50 million and 2 billion, which is really the engine of the UK. And what you see is these groups have, or these companies have not actually been able to raise much capital. Furthermore, if you look at where that capital has come from on the right-hand side, you see two lines. The first line, the dark blue line, is non-domiciled funds. So these are international funds investing in the UK. And what you see is around the time of the election at the end of the last year, there was a bounce where money came into the country. Then obviously when COVID came along and uncertainty around Brexit during the course of the beginning part of this year, a lot of that international money then left the country. If you look at the UK domicile funds, it's interesting to note that there's actually not been a big increase. So what's happened here is when investors invest money in the new issuances raised in the new issuances by companies, they're effectively circulating old money. So it's effectively selling shares that they already hold in order to make new investments in the secondary issuances or the IPOs of companies. In our view, what the system in total needs is more equity. It's simple, though, to say more equity. Now let's talk into what type of equity, because I think it's fair to say that what we've seen over the course of this year is a big range of companies with a big range of outcomes. And our suggestion is not that every single company should be saved. Every single company should have equity. What we want to do is focus on the companies that will make the biggest drive and biggest improvement for the country. And so here we list two types of companies that we see as particularly attractive. And we deliberately tried not to use the term value because that's obviously a very common term, and also just the basic term of growth. Instead, what we've said is high growth and mispriced growth. Now, what we mean by these two categories is these two categories are in both cases companies that have been very successful for a number of years. They're companies that have in many cases had double-digit revenue growth, double-digit earning growth. They've got very strong KPIs. They're often market leaders in what they do. The only difference between these two types of companies is what's happened this year. What we see in the high growth companies is high growth companies have actually seen a spike in their revenues. They've actually had a positive or have been affected positively by COVID. A lot of people obviously think about Zoom and they think about Amazon as companies that have had kind of a successful calendar year 2020. There are actually quite a large number of British companies that have had an equally exciting calendar year 2020. I'd say it's a bit unfortunate that we don't shout enough about some of our own great success stories, because there really are a number of UK companies that have had a stellar year this year. The second type of company we list on this page is the mispriced growth. So these companies also have had a great success in the past. The difference is these companies have had a bit of a hit this year due to COVID. So they've been negatively affected by COVID. Now, what we mean by these is we do not mean turnaround or distress. We do not mean broken companies or companies that are really struggling. Instead, we mean companies that were on a strong growth trajectory, where their market is still strong. They have had a drop this year, but with a bit more equity, a bit more capital, they can be returned to their growth. So an often cited example here would be companies that have been through some form of M&A or merger and acquisition, kind of a build-up play, where they are companies that have been scooping up smaller competitors in order to grow. But companies where that growth strategy of doing small acquisitions had to take a pause this year. And the reason it had to take a pause this year is obviously because of all the dynamics happening in the country. What we see is if we give those companies a bit more capital, we can help return them to their former growth. We can help ensure that they have more capital, equity finance capital rather than debt finance capital, in order to return to their growth acquisition that they had in the past. So these types of companies of high growth and also mispriced growth, I'd like to emphasize, are available across the entire UK landscape. They're available across the entire country from north to south, east to west, but also perhaps most importantly, they're available in both public companies and private companies. One of the challenges for investors, and particularly retail investors, is it has always been very challenging to access private companies. And so what we strongly believe is that retail investors in particular should be able to access the private companies, because this is a large proportion, particularly of the high growth part of the UK landscape. So we've talked there a bit about growth and how growth is really important, and how there are actually a large number of high quality growing companies in the UK. But I think it's very important that as investors that we act with significant responsibility with our capital. Often people talk about how capital can control behavior, and that's something that we also strongly believe. We strongly believe that now is the time for asset managers, investment managers and wealth managers to really look at not only making really strong positive financial returns, because clearly everyone wants to make nice returns, but also to do it in the right way. We want to see people investing their capital in order to help the companies grow. And so the two parts of this slide that I specifically want to highlight are the last two boxes, where we talk about helping companies achieve first-class governance. This is something that is particularly required in the smaller end of the spectrum of companies between 50 million and 2 billion, where an institutional investors can really help enhance and improve the governance of these smaller companies. But I'd also like to highlight that we believe it's really important to act as responsible stewards of capital. And the reason for that is because, as I say, capital can influence behavior. So how is it possible to influence this? How is it possible to make both good investments, but also make successful investments, but also make them in a positive way? There's many different tools, many different frameworks available, and two of the most established or two of the most useful tools are listed on this page. The first is a Schroders in-house tool, which is called Context. Context is a tool that looks at public companies in particular, and it looks at all the different data points from those public companies that is publicly available. So this can be not just, of course, revenue and EBITDA numbers and profit numbers, etc., but it can also be about things such as how long does it take a company to pay its suppliers. The software that Schroders has developed, the context software, has been built by an in-house data insights team called the Data Insights Unit, which is some 25 plus person team of effectively rocket scientists. So they often came from a non-financial background, and we brought them in order to add a level of analytics and decision and IT capability that we think is really useful. And so they've helped create this context software. And I should mention there's over 160 different metrics that context looks at. Another tool that we like to use is the UN SDGs. Now, these are not ones that were developed by Schroders in any way, shape or form. They were developed by the United Nations. The SDGs are called the Sustainable Development Goals, and there are 17 discrete goals. And these 17 goals are listed on this page. In addition to the 17 goals, there are actually 169 sub-goals or 169 targets. The way that we think it's important to use the SDGs is to use them in two different ways. The first is to look at the business models of the companies that people invest in order to look at whether the business models help deliver against the goals or the sub-goals. Now, if you're investing in companies that work in the healthcare space, or if you work in the education space, that can be relative, or even in the renewable energy space, that can be relatively easy. The second way, though, that we we use the SDGs is a way that ensures that we can use them across all companies, across all industries. And that is, we encourage the management teams and the boards of companies in order to incorporate the SDGs themselves in their own business operations. And so, for example, what we ask management teams to do is we ask management teams to record and track topics such as the health of their employees, also the education levels. But more importantly, it's not just the starting education levels, it's how much help do they provide their employees, how much training do they provide. We also ask the companies to report on things like gender equality, and it's surprising how many companies can talk about and report about their energy usage and their water usage. Is their energy usage from renewable sources or non-renewable sources? What's been really powerful and useful with the SDGs is twofold. The first is the companies themselves, the management teams have really embraced the SDGs. And as I say, this is not a Schroders topic. This is something that is being used by companies and countries globally. So they're very easy to understand, and therefore management teams have actively embraced these. The second thing that's really useful about the SDGs is that we ourselves can aggregate this information and report it on to our own investors, which allows investors, whether it's institutional investors or whether it's retail investors, to really have a good understanding of the impact of their capital. They can see how the money that they invest is being used not just to make good financial investments that are successful for them, but also that are making a positive impact on society overall. So we've talked a little bit about what we see in the UK, and we've talked a little bit about what to do. I think the next slide or two, I'd like to talk about how to do it. And here I'd like to talk for a few moments about investment trusts. In our view, investment trusts are very interesting and useful investment structures. And they're particularly useful because they enable, or that we believe they're the most perfect structure for retail investors to be able to access private equity. Many of you will know investment trusts well, and you'll know the differences between investment trusts and other more open-ended vehicles. But just for a few people who may not be so familiar, I'll say a few words. So an investment trust is a vehicle that's listed on the London Stock Exchange. Investors can buy shares in that investment trust. And at that point, the manager of the investment trust then gets to make investments into companies. The most useful aspect of this topic, of this structure, is that if those investors wish to sell the shares, they can sell their shares at any point, any day during the course of their ownership period. And the advantage of the structure is it means that the fund manager, the investment manager, does not have to sell the underlying assets in order to repay the original investor. This is really useful in particular for private equity assets, because of course private equity is a more illiquid asset class, and so this structure allows a liquid investment style of buying shares into a company to work very well with an illiquid investment activity such as private equity. What we've seen is, of course, there's a lot of challenges also with investment trusts. One of the big topics is around the nature of a discount. Many investment trusts have traded discounts. What's quite interesting, though, is many investment trusts actually traded a premium in the early years. And so we always recommend to investors to look at the structure of the investment trust and look at how the investment manager is working in order to minimize the investment trust structure. I've talked a little bit about private equity and about the benefits of investing in private equity and public equity, but I do also want to talk a few words about some of the challenges. One of the challenges is that private equity and public equity are indeed different asset classes effectively. There's of course many similarities. It is indeed about investing equity into companies, but the way that you go about identifying private companies and identifying public companies is very different. The way you go about accessing those companies and the way you go about making investments into private and public is different. And so the way that we've developed or the way that we manage this is we have two separate teams. We have a public equity team, and many of you will know the Schroders public equity team. It's got a long track record of successfully investing in the UK in both value strategies and also more growth strategies. What maybe fewer people are aware of is the private equity team. This is a distinct and separate team within Schroders that is dedicated purely to private equity, where all the professionals have spent most of their careers working on private equity. And we think that's really important because it ensures that the team is well connected in order to be able to access the best deals. Now, of course, an investment trust structure has a board, and so on this page we've listed the board, or we've listed the fact there is a board. The boards of investment trusts are really important. They are independent individuals who hold the investment manager accountable for what they're doing. And we've seen boards taking a very active role in the management of investment trusts in recent years, and we think that's a very good thing because it's really the responsibility of the board to actively work with the investment managers, but also to work on behalf of the shareholders. Something that I'd like to mention for more complex structure of a public and private vehicle is the importance of having some form of internal governance. And we've seen different successes and challenges with governance within hybrid vehicles across the UK in the past. Our own view is if you're going to run a strategy with two teams, with a public team and a private team, you actually need to have more than just double the level of oversight. So therefore, you shouldn't just have the oversight and the governance of the public team or the oversight and governance of the private team. You actually need to have a third level, which we often call the oversight committee, in order to ensure that the teams work for the best nature, not just for the individual public assets or the individual private assets, but for both assets combined together. Now, Ross had mentioned that the UK is unloved, or could be perceived to be unloved, underestimated, and undervalued. One of our strong views is we believe that if you invest across both public equity and private equity, you're able to overcome some of those topics. So with regard to the topics of each of these three applied to the public side, as Ross did, I think I very much agree with many of the things he said. What I would like to point or say a few words about, though, is how those three words fit against the private side and the private equity side. It's quite interesting to note that the UK private equity industry, the UK private equity market, is actually one of the most sought after private equity markets in the world. The UK private equity market has performed very well through many economic cycles, and therefore international investors and institutional investors are heavily targeting the UK private equity market. I think it's fair to say it is underestimated. It's perhaps also kind of maybe unknown, and it's difficult to access. I think also the topic about underloved or undervalued is also a really interesting point, because private equity is indeed undervalued in the UK. It would be our view that if you look at the number of people employed within the UK within private equity, which is a significant proportion of people in the private sector, it really should therefore be reflected in the asset classes that people invest upon. Now, I'm very conscious of time. I want to ensure that we both have enough time. So I think on this moment, I'll bring the presentation to a close in order to ensure that there is enough time for my fellow speaker. And if there's any questions, I'll be happy to address those questions in the Q&A section at the end of this presentation. I therefore would like to thank you for your time.